Imagine this, a stock trading under $5 suddenly lights up the options market. Calls and puts are flying, traders are choosing sides, and the real question becomes, who's going to win this battle? The longs betting Opendoor surges higher, or the shorts, convinced it's destined to drop? This isn't just another penny stock move. This is a war between conviction and fear, between retail hype and institutional caution. Today, we're diving deep into Opendoor stock, why it's getting so much attention right now, and what this options signal around the $5 mark could mean for anyone considering a trade. Stick with me because by the end of this breakdown, you'll have a much clearer picture of whether Opendoor is a risk worth taking or a trap waiting to snap shut. Part 1. What is Opendoor and why it's back in the spotlight? Opendoor is a real estate technology company that pioneered the iBuyer model, buying homes directly from sellers, fixing them up, and flipping them quickly. At its peak during the housing boom, this company looked unstoppable. But when mortgage rates spiked and home prices softened, Opendoor stock fell from the double digits to well under $5. Now it's suddenly back on traders' radar. Why? Two big reasons. Short interest remains very high, meaning a large group of traders is betting the stock will keep falling. Options activity has exploded, with traders aggressively buying both calls and puts around the $5 level. This combination sets the stage for volatility, and possibly a squeeze. Part 2. The longs argument. Let's look at the bullish case. Long investors argue that Opendoor is finally stabilizing. The housing market, while still challenging, is showing signs of resilience. Mortgage rates may have peaked, giving buyers and sellers some breathing room. On top of that, Opendoor has been cutting costs, streamlining operations, and focusing on profitability. If they can prove to Wall Street that they can survive this high-rate environment, the upside could be significant. Some bulls believe Opendoor stock could break out above $5, triggering technical buying and attracting more momentum traders. Part 3. The shorts argument. But the shorts aren't backing down. Their case is simple. The housing market remains fragile, and Opendoor's business model is still risky. Every time rates move higher, affordability drops, meaning fewer transactions and lower margins. Shorts argue that even if Opendoor cuts costs, it still faces fierce competition and thin profit margins. And with the stock under $5, they believe there's plenty of room for further downside. In their eyes, any rally is just an opportunity to short into strength. Part 4. Why the $5 options signal matters. This is where things get really interesting. Options traders are clustering around the $5 strike price. That means both longs and shorts are fighting over whether Opendoor will stay above or collapse below this psychological level. Call buyers see $5 as a breakout point. If the stock clears it, the upside could accelerate. Put buyers see $5 as resistance. If it fails to hold, the stock could slide lower, maybe even towards $3-4. When options volume spikes like this, it tells us traders are preparing for a big move. Not small, not sideways, a breakout or breakdown. Part 5. The risk versus reward for traders. Now let's be clear, Opendoor isn't a safe stock. This is a high-risk, high-reward play. If you're bullish, you're betting the housing market and company fundamentals improve. If you're bearish, you're betting the opposite, that the pressure from rates, inflation, and housing affordability crushes them. For traders, the real opportunity lies in volatility. Whether you're playing options or simply trading the stock, this setup can reward quick decision-making, but it can also punish hesitation. Part 6. The bigger picture. What we're watching with Opendoor isn't just about one company, it's about how traders interpret risk, how housing stocks respond to economic signals, and how retail versus institutional investors clash in the open market. Think about this. If Opendoor breaks above $5 and holds, it could trigger short covering, which would push the stock even higher. On the other hand, if it fails and falls below support, shorts will gain even more confidence and longs could get wiped out. So, here's the big question. Who wins the Opendoor battle? Longs or shorts? The truth is, both sides have strong arguments, and the outcome depends heavily on housing data, interest rates, and Opendoor's ability to prove it can survive. If you're considering trading this stock, do your homework, manage your risk, and never let emotions drive your decisions. The volatility may look exciting, but it can be dangerous if you're not prepared. That's today's breakdown of the Opendoor options signal and the $5 battleground between longs and shorts. What do you think? Does Opendoor have a shot at turning things around? Or is this just another setup for the shorts to win? Let me know your thoughts in the comments. If you found this analysis helpful, make sure to hit that like button, subscribe to the channel, and turn on notifications so you don't miss future updates. Thanks for watching, and I'll see you in the next one.